My name is Jeremy Duncombe, and I'm Director of Intermediary Distribution at Accord. So welcome to today's session on a day in the life of a lender. A lot happens in the day of a life of a lender. Never is there a day that is the same as the other, but really what I want to talk about today are some of the decisions that we make, the reasons that we make them, and how that impacts on the service that we offer, the capacity that we have, and also the way that we work with you, our administrators and our mortgage brokers. So I think that's really important. The more we can share and we can work together, the better the outcome for the customer and you as brokers. So helping us to help you is another really important message today. And I hope you find it interesting, useful, informative. And there will be some chance at the end to ask some questions as well. So here we go. So, a day in the life of a lender. These are the topics I'm going to cover, a number of things here that really impact on the decisions that we make and the reasons we make them. What are our lending strategies? How do they impact on the decisions that we make? Pricing and criteria, what goes into choosing our pricing and our criteria, why do we lend in certain areas? Our loan to values, very topical at the moment, talking about 90% lending for some lenders as well. And what that does to our service, really, really important that the service levels are maintained as much as we possibly can. And that comes with the broker support that we provide, but also you provide to us to help us to make that service proposition that we have. Really important is our communication and also working together. So I'm going to talk about all of those today and then some next steps, maybe some things to take away and certainly an opportunity to ask me some questions live at the end of this presentation. Lending decisions for us are made up of four main inputs, but ultimately it comes down to our appetite to lend. First of all, we've got to have the money to lend. So where do we get our capital from? Have we got enough? And then from there, how accessible is it? How liquid is it? And what do we have to do in terms of provisions and making sure that we've got enough left to lend over? So capital and liquidity is really, really important and how that works. And then our attitude to risk, not necessarily our risk appetite, it's our risk attitude. What do we feel is a right area to lend in? What is our view to certain sectors? And then what level of service can we provide off the back of that? If you put all those together, it really comes up with our appetite to lend. And then from there, the decisions follow through. So in a bit more detail, let's start with the capital and liquidity. First of all, lender by lender, all lenders have slightly different funding models. Where do they get the money from? From our point of view at Accord, being part of the building society, our money comes predominantly from our savers. So that's through our branch network, also online and through the telephone. So we have money coming in from customers out in the market. But we also raise money through securitizations and from whole loan sales as well. So we have a wide-ranging funding model that allows us to be flexible depending on the cost and the value and how much we want to raise. So that's great from our point of view. Other lenders don't have the savers, so they have to raise all of their money through the money markets. Often that's absolutely fine, but we do see sometimes more volatility with lenders who only pursue a certain model. So it's really interesting to see the different funding models out there and also the different cost of funds as well. Depending on your size, access to certain government schemes, your cost of funds can vary quite significantly. And again, being a large building society with savers and a very good back book, it means our access and cost of funds is pretty competitive. It allows us to be out there with good capital and good liquidity. You also then look at regulation. What is the regulator saying to you? Are they concerned about how much risk you're taking, or have you promised the regulator how much you would lend in certain sectors of the marketplace? And that's really important. What your priorities are. Do you have priorities towards shareholders? Or from our point of view, we're trying to provide real help with real lives to our borrowers, our brokers and our customers. So that means we may be more focused towards first-time buyers, for example, or people moving home as opposed to necessarily remortgage business, just because it fits with our priorities. And then what do you have in terms of reserves and provisions? That's really important as well, to make sure that should anything go wrong, you are well provided for. So once you've got the capital and the liquidity, you start to look at your risk appetite. So which sector do you want to lend in? Is it first-time buyers, remortgages, capital raising, all those different sectors? And they all come with different risks that you need to price for. For example, a very low loan-to-value remortgage, very, very little risk. 60% remortgage is negligible risk. However, the margins that you earn from that, again, are going to be relatively small. So if you're going to specialize in that sector, probably need to writing high volumes with low margins. So trying to have that split, not doing everything in the high risk, high return sector, certainly for us, but having that balance so that your book is balanced as well. The regulator is happy, and you also stay within your loan to value limits, because all lenders have their own limits that they want to lend in each loan to value sector. And I'm sure we'll come on to loan to values later on. There's also experience and history and back book. So you learn a lot from your history and back book, but also it gives you that security behind you that you have got a very strong balance sheet and lots of pre-existing customers. And that's really important. It not only helps you with your liquidity and your reserves and your provisions, but also helps you when you're forecasting what you want to do going forward. That forecast may also build in things like the economy, what we think is going to happen there, loan to values, house price inflation, and more importantly, recently, all of those factors have been taken into account. We were concerned very early on in the crisis around the impact on house price inflation. A number of forecasts were saying that there could be a quite significant drop in house prices, and therefore lenders quite quickly pulled out of 95% lending, and we pulled out of 95% lending as well. What then happened is a number of lenders pulled out of 90 because of capacity issues. And from our point of view, it's very much around capacity and not because of any concerns necessarily about the risk of those borrowers. It's more about the capacity that we had to lend to them. But that still comes down to capital liquidity, and your risk appetite is based on that as well. In terms of strategy, what strategy do you want to pursue? We've talked about low volume, high volume values as well. So if you're doing remortgage business, again, I said you probably need to a lot of volume on that because the value of those are very small. So it's having that balance. From our point of view, most of our business is built around relationships with brokers. We want brokers to come back time and time again once they've tried our service, and they like what they see, and they like the fact we do individual underwriting, common sense underwriting on a case-by-case basis. So once we've built that relationship, we want the customer, our customer, i.e. the broker, to come back to us time and time again. And therefore our reputation is part of our strategy. We want to continue to be providing the best possible service and ease of use for people so they come back time and time again. And really importantly, therefore, is how we communicate, particularly in the current crisis and the products changing so regularly and things being pulled at relatively short notice. We need to try and explain those decisions up front and explain why we're making certain decisions. And hopefully that helps. It helps with you having conversations with customers, explain to them what's happening, why certain products are available and why others aren't. And I think that's really, again, important that we make those messages available to you. So, for example, moving out of 95% lending and moving to 90, and then having to pull out of 90 was down to the capacity that we had. We couldn't cope with the volumes that were coming through, and therefore to protect our service, we had to pull out. But we were very clear in communicating that was the reason. It wasn't because of our risk appetite. It wasn't because we felt house price inflation was going to be an issue. But it did mean that we signposted that we would like to get back into that market as quickly as possible. We talked about why we'd made the decision. So that communication, I think, is really, really important. And then signposting when we may be able to come back into the market to help you. But ultimately, that comes down to our service. The technology of our MSO system really helps. That allows us to be efficient and to process the cases that are relatively straightforward very, very quickly. And the importance on that for you as administrators and as mortgage brokers is the better you package that case on day one, the more information we have up front with that case on day one, is it can be touched once and offered. We don't have to come back out to you and ask for more information. You don't have to go back into a queue when, particularly when service levels are higher than we would ideally like. So being very, very clear on day one with our communications and saying, please package on fully, will get you a better service with our system, which is very, very efficient. We don't want to be black and white criteria, so we still have that ability to underwrite cases on a case-by-case basis. But obviously that affects our capacity. You know, we have to have more underwriters to do that sort of job. But we also need to make sure that the underwriters are doing exactly that. We've had to move some colleagues into other parts of the business, particularly our collections business, and that has impacted. Fortunately, those colleagues are now pretty much all back within the underwriting teams, and we're also seeing our colleagues come back from either shielding or from looking after children. So our capacity has increased quite significantly, but can increase further with some of the tips and ideas that we'll talk about later on today. The other thing for a lender to look at is their channel mix. Around about 85% of our business now comes via the intermediary. So we start to be flexible with our resource around that to make sure we can continue to provide that service. And to cope with the peaks that come through, because they will come through. And when we do get a peak, we need to recover. So hence communicating, pulling products, explaining why, and then try and communicate to let you know how long our service is going to be. So they're all really important messages. And ultimately, this comes down to broker support. The more we can support you, the more you can support us, and we can work together to get through this as quickly as possible and then get back out to lending in those loan to value areas that you want even more. So working together is a real theme. What's in it for me? WIIFM. And that's something that you should ask. Why would I spend more time on a case on day one? Well, what's in it for you is a much quicker turnaround and a much quicker offer. We have a quite finite number of colleagues, and really we need to know how best to deploy them. The best way to deploy them is on underwriting cases. So from your point of view, to help us to help you, find out what we offer, find out what our proposition is, and where you can find that information. Our website's fantastic. There's a lot of really good information on there. Our MSO system gives you case updates, so you don't need to ring us. You go into your portal, and every case is in real time updated, so you've got full access to case updates at all times. So there's lots of things that you can self-serve on, and that means you're not in a queue, you're not waiting for a telephone to be picked up, and you're not waiting for our web chat teams to work through and work through their queue. So there's a lot of things that can help you to get a better service, and I've touched on it before about fully packaging cases on day one. Another 20 minutes checking paperwork, making sure that everything that we may ask for is submitted with that case on day one will turn around that case so much quicker, several hours quicker, because it won't need to go back into that queue when we ask you some more questions. And work within our published times. So all of our all of our service levels are on our website. So again, if it's within those service times, there's no need to ring us, because we will come back to you within that turnaround time. So in terms of improving service, the more time we can spend on processing, the better. The quicker turnaround we can give you, and the fewer questions that we need to ask you. Less time you have to spend talking to your customers and keep going back asking for more information, and far more time then for our underwriters to spend on new queries, and more capacity for us as a lender to launch new products or stay out there for longer with high loan to value. So much better outcomes for all right across the board. And it's two cycles really. The good cycle, which we all want, is creating capacity to lend, launching products and keeping them out there, working with you to make sure that we do our best with those to provide a better service and build our relationships. The bad cycle, unfortunately, is where the opposite happens, and by not working together, we have service issues, we have to pull products, and we can't create that capacity. So good cycle, bad cycle. And in summary, that's really what we've been talking about. The lender decisions are based on lots of conflicting requirements. We have to make decisions based on what we see in front of us, based on what we think is going to happen, and based on the back of our experience and what's happened in the past. So we are making decisions all the time. Generally, all lenders, I think, make decisions in good faith. We certainly do, to try and put our brokers at the forefront of what we're doing by signposting and communicating what we're going to do and why. It won't always be popular, but it will always be thought through and tried to be as impactless as we can make it, if that's a real word. We all want the same thing, and I think help is out there. The help is that you can provide us with better package cases. You can spend a little bit more time on them up front, and we will turn them around much quicker. If you use our website for things like information you need, but also check our SLAs to make sure that the case that you've got is within timescales, and to use our portal, our MSO portal, for case updates. And then when you do ring us or you come through on our web chat facility, you're more likely to get through much quicker, and our BDMs, our BDAs, and our underwriters can work with you to provide you with the best answer on your next new case, which will be the ideal thing that you want to then send your next case to us. So I hope that's been useful. Lots of background on why we make decisions, also some ideas and hints and tips to help us to help you. And what I'd like to do now is pass over to you to ask any questions you may have.